Hello and welcome. You're watching Commodities First right here on ET Now. I am Ajay Sharma. Let's take a look at the key headlines right now. Oil prices are slipping in trade as hopes of a production cut by the OPEC is diminishing. The initial euphoria around Russia and Saudi Arabia's deal to work together to resolve the supply glut is also fading away as investors cast doubts over whether the nations can deliver on all the talk. The rupee started the trading week on a high, jumps to its highest level since May after lower than expected US jobs data reduced fears of a rate hike by the US Fed Reserve. Strong FI buying in the domestic equities also gave the currency a strong fillip as the rupee finally ended the day at the highest levels against the dollar since May of 9th. The weak dollar also is pushing gold prices higher after hitting a 2-month low last week. Gold was glittering again as US employment data missed all expectations, indicating that the US Fed will not raise rates in September. Hi there, you're watching ET Now, Commodities First. I'm Ajay Sharma. Let's keep the focus on oil today as prices have erased after the initial euphoria around Russia and Saudi Arabia trying to work out a deal or a resolve to cut the supply glut. In fact, the latest one, of course, Iran is also saying that they are not averse to the idea of coming on the table and discussing some kind of a stabilization mechanism. We have an expert voice joining us on the show all the way from London. Hitesh Jain will also be there on the show from IIFL, but currently we have Emma Richards, a senior oil and gas analyst at BMI Research from London. Emma, thanks a lot for your time. What are you making of the developments right now? Now Iran says that they are also not averse to the idea. Do you think Iran can also come on the negotiating table?
I think they would find it very difficult to do that politically. I think if you look technically, yes, they would be able to. They've obviously had a huge amount of production growth over the last few months, but it's looking like incremental gains from here on out will be a lot smaller. So I think technically they're in a much better position to freeze production now than they were in April. I think the difficulty is how they would sell that domestically, politically, because you still have a very strong hardliner faction in Iran, and I think there would be huge opposition to any participation in a cut. And if you listen to what they've been saying, they've said that they would support measures to improve oil market stability, but they haven't actually said explicitly that they would participate in any of those measures. So that's quite significant, I think.
Sure, but why is all of that not getting reflected in the prices? Hitesh, what are your thoughts? You must have observed all the commentary coming in internationally right now.
See, although there is a concurrence between the key players like Russia and Saudi Arabia as far as price stability measures are concerned, according to me, does not translate into anything, and the so-called freeze is nothing but a farce. Now, let's look at the numbers. Suppose when they meet next month in Algeria, all the oil producers, and they go for a freeze. The important point, the moot point is what level they freeze output. If they freeze output at August levels or the recent levels, in August, OPEC is reported to have produced around 33.5 million barrels per day. Saudi Arabia produces around 10.7 million barrels per day. All these numbers are already above the projected demand numbers. So if you look at IEA numbers, which are the projecting demand for OPEC oil at 33. See, obviously global oil demand stands at 96-97 million barrel per day, but for the OPEC oil it's around 33. So the existing number is already above the projected demand number. And given the glut which we have on the inventory side, talk about US inventory levels, or you talk about the OECD inventory levels which are multi-year high. You look at the OECD inventory of both crude oil and refined products, downstream and upstream product. It clearly shows you a glut. You're not seeing moderation in supply across the globe, barring US, which is showing early signs of bottoming up. Now, I don't think so. US oil output is going to go below 8.5 million barrel per day. So whatever measures they take, it fails to mitigate the existing glut or recalibrate the equilibrium. Now look at the global demand supply gap. So if you look at energy intelligence number, the gap between supply and demand during the first 7 months of this year stands around 1.5 million barrel per day on average. If you look at last year from January till December, the gap was around 1.2 million barrel per day. So nothing has changed. The oil market still remain in glut. There was a perception a few months back when we had supply side issues emanating from Canada, Libya or Nigeria that slowly the markets will be balanced. But I don't see such signs emerging.
You actually raised a couple of very interesting points. Emma, I would like your opinion on that. Hitesh believes that the big glut which exists in the market, that is not getting absorbed in a very high rate, and that is a very big worry. What are your thoughts on the natural adjustment which is supposed to happen? That glut is not getting adjusted.
Yeah, I would agree. I think it's happening. The market rebalancing is happening much more slowly than was anticipated, and certainly I don't think you should expect to see that cleared until well into the next year. I think the main weakness at the moment is coming on the demand side, because when you move into September, October, consumption level comes off quite significantly in some of your big consumer markets like the US. You also have refiners moving into maintenance season, so that reduces demand for crude. And if you look at the refining margins the last few weeks, they've come in quite sharply again in some of your big key refining centres, so that should push down utilisation rates at operating facilities. So all of that says that demand is going to be a bit weaker September, October than it has been, and again that's going to just delay that process of rebalancing. I think on the supply side, as was said, OPEC production has been very high. There is some seasonality to that, so you could expect to see OPEC production fall off very slightly over the next few months, but it's likely to remain elevated, and yeah, we're really relying on supply pullbacks in the US and in places like China, Mexico, Venezuela. We really need more declines there before that market can fully rebalance.
Fair point. So in that case, Emma, where do you see the prices head from here on? There's been a big rally. After that, not much ground has been lost. Do you think prices may remain at current levels till this informal OPEC meet? And after that, again, things may start going back to the way they were at the lower levels?
Well, I think that there seems to be quite a firm trading band established between around $42 and $52 per barrel, and I think they're going to stay fairly range bound there for probably the rest of the year, actually. I think there's nothing fundamentally that will cause them to break upwards of that. I think the only thing that could cause a break kind of sustainably above 52, 53 would be if you saw a coordinated cut by OPEC. As was said, it wouldn't make any difference in terms of the fundamentals, but I think it would have a big impact on sentiment, and that could be a trigger for an upwards break. Having said that, I think the prospects of any kind of a freeze is so very unlikely at this stage.
Most of the people who've been coming on the channel and on the show believe that, like always, this will be an inconsequential kind of a OPEC meet. Hitesh, what are your thoughts?
I think from a 2 or 3 months perspective, oil prices remain confined in the familiar range, probably $38 per barrel to $50 per barrel. But in the meantime, I do not rule out a downside till 40, 41 in the coming weeks and the coming month, 1 month or two. See, the reason being, we need to understand the remedy to lower prices is low prices itself, or supplies or concrete supply side measures. And I'm really skeptical whether OPEC is going to cut output, given the fact that they did not do it when the prices were at much lower levels. So I think we are going to remain in the same range for quite few months, and $38 to $50 per barrel seems to be the range.
Right. Emma, overall, what are your observations? You have indicated earlier in the show that around next 1 year, which is 12 months or thereabout, you expect then onwards some adjustment may start. Have you done some research or looked at slightly longer term the factors at play, and by when will that extra barrels which are still existing in the system actually start adjusting? Because Asia is clearly witnessing some good growth led by China, India. And in fact, just to bring it up, because both of you track the area closely, fuel demand, in India at least, the diesel and petrol demand is heading at an 8-year high and only growing when we speak to the large refiners. If Chinese demand also starts rebounding a year from now, or at least the contraction stalls, don't you think that the energy demand will come back here?
Yeah, I think so. As I said, we forecast supply and demand, and based on our forecast, we're expecting the market to move back into a deficit by the second half of next year. And that's driven very much on, as you said, demand side factors in Asia, to a lesser extent supply curtailments in the US, and then some of the big mature producers in Latin America and North Asia are also facing some pretty strong decline rates. So assuming that those kind of trends continue, then yeah, we would expect the market to rebalance by the second half of next year. But as we said, you do need low prices to remain for a significant longer period of time before that process of rebalancing can fully happen. And even when it does, I wouldn't expect to see a massive spike in the price, because if you look at the overhang in crude inventories, you have hundreds of millions of barrels that have gone into storage over the last kind of 18, 24 months. And when the market begins to rebalance, you're still going to have a long period of adjustment before those storage barrels can be fully unwound.
Sure. What are you recommending your clients to do in terms of possible trades, both on the short-term, near-term ones and the ones who look at much more positional trades?
See, I already I already reiterated that we see the same range prevalent for quite some time. But as far as short-term perspective is concerned, we have a conviction that oil will find very difficult to surpass or sustain above $50 per barrel. Although prices have retraced, you may see prices again moving back towards 48, 49, given that there will be some kind of lip service from OPEC and a lot of oil producers. So whenever oil prices move towards those 47, 48 per barrel levels, we prefer to short.
Right. Even natural gas prices, for that matter, at least the area we are actually importing from, have fallen very sharply. Emma, what are your thoughts on natural gas overall? Do you think it will closely follow what's happening in crude?
Yeah, so the liquefied natural gas market has also seen very sharp declines in prices over the last 12, 18 months. There's two factors at play there. One is that contract prices are very heavily indexed to oil, so they're going to stay weak for the foreseeable future, I would say. The other factor is that you have weakness in the spot market because there is massive oversupply building globally in LNG, and looking at the pace of supply additions that we're forecasting over the next 3 to 4 years, and looking at the lag that it will take for demand to catch up with that supply, I think spot prices for LNG will probably remain very weak until around kind of 2018, 2019. So I think the recovery in gas prices will, if anything, be even slower than the recovery in crude prices.
Right. All right, Emma, I'll let you go on that one. Thank you so much for joining us on the show today. Hitesh, of course, stays back with us on the show. Hitesh, let's take the discussion on the precious metal side. There has been a very smart rally on gold as well, around 1350 odd, but beyond that, it's finding it a bit struggling to cross that. What are your own observations?
See, there are compelling narratives which says that gold still remains in the reckoning as far as investment product is concerned. And what we are seeing, this transient pause, is nothing but a comma and not a full stop to the overall structural bull run. Now, it's a cliche if I mention all the factors, including negative interest rates, no improvement in aggregate demand, failure of monetary policies, and the fact that everybody knows now that more than 1/3 of the sovereign bonds traded in the developed world fetch you negative interest rates or the negative yields. So such kind of system is dysfunctional, and eventually people will flock to an instrument which is safe and returns or delivers you positive returns. So gold as an instrument stay in the reckoning. If you give me a broader perspective or ask me for a broader perspective, we are very much bullish on gold, and will not be surprised gold moving at least toward $2,000 to $2,200 per ounce in the next 2 to 3 years.
You have actually brought up a very interesting point, Hitesh, because in our daily course of interacting with fund managers across the world, not only India, the several global fund managers have started recommending their clients and at their own fund level to raise your positions towards gold at least 10-15%. Some of them talk about 20% exposure to gold in order to hedge their portfolio, because in developed markets what they are observing is that the stock prices are going higher, but the underlying earnings are not actually going higher in the same rate, and hence they feel that their portfolios are vulnerable. So you believe that kind of investment demand is also likely to escalate over the next couple of months, because emerging markets are a different story. Some of them with structural strength like India may be okay, but others are not. Developed markets, of course, earnings are not rising, and hence the demand for investment in gold can spike suddenly in the next couple of months.
See, as far as the global markets are concerned, there is definitely an element of asset mispricing, because if you look at the way global markets are doing, look at bonds or look at equities, they're moving in tandem. Generally, never happens. There's a wonderful saying in English. They say is you cannot hunt with the hound and run with the hare. So both things don't coexist. Somewhere definitely everybody's riding on the same boat called liquidity. And with no improvement in aggregate demand, and clearly there's a clear signs of monetary policies failing, people will look for an alternative asset class like gold. And there are clearly early signs where ETFs are back in the business, where after a pause in 2013-14, they're back in the business where the holdings of various ETFs have surged by a big amount. Talk about SPDR, Gold Trust, or various other ETFs as well. So I don't see. I have no doubt regarding gold as an investment avenue which can, in fact, exceed the returns in areas of other asset classes as well.
So the two questions come to mind. At IIFL you have all categories of investors, both HNI and retail. For somebody who likes to keep more of physical asset as an investment, what are you recommending them? And the ones who are trading gold, do you think dips should be bought? Because the next couple of months and maybe beyond that, the trajectories are upward. So any sharp fall should be used as a creating of a position.
As physical gold is concerned, I think sovereign gold bond scheme is a wonderful instrument. Put your money, and as far as you said, the long-term perspective, people who are ready for a long-term perspective, I think 1280. Whenever you see prices dipping towards 1280, $1,300 per ounce is a lucrative opportunity, and we believe that prices should stick or respect those support levels. So any dip should be taken as an opportunity, and the longer-term perspective we stick to our targets.
Hitesh, what about silver? Because silver, of course, is the choicest of instruments for traders, but because of its low investment demand, is not spoken about in terms of physical, keeping it in physical form.
The difference between gold and silver is gold is more deemed to an alternative currency, but silver is still a commodity. So everything ends up with the supply demand equilibrium. You look at silver, the supply side is definitely constant, but the question comes on demand side with the prospects of various industrial commodities, a big question. I think silver may move in tandem with gold, but we are not that bullish on silver as compared with gold.
Right. All right, Hitesh, we'll let you go on that one. Thanks so much for joining us on the show today. Really appreciate it. Let's take a short break. On the other side of the break, we'll talk about currency space, where there has been a very sharp rally in the rupee. In fact, the biggest single day session has been clocked today since May 25th. FI buying continues to remain very strong, 1,500 crores bought today. We'll discuss all of that with the special guest on the other side. Welcome back. Still watching Commodities show right here on ET Now. Let's talk about emerging markets. Emerging markets have been overall, the currencies have been doing very well. But rupee clearly in the last couple of days, in fact today too, there was a very good day. 66.5 is almost here as far as rupee is concerned. Couple of factors. Flows have been very strong to bond and equities, but equities have been picking up. In fact, just today, if you look at the flows, almost 1,500 crores have been bought by Indian stocks, have been bought by FI. So apart from other factors, this has also been one of the big contributors. Bhaskar Panda, Senior Regional Head Treasury Advisory at HDFC Bank, is here with us. Bhaskar, thanks for your time. What are your observations? How are you reading the strength? Has it surprised you, in a big way?
Good afternoon. I think if you look at the prices, it has moved below the trend line that has been holding for since Q2 2014. In fact, it has started coming below that for last few weeks. So but one must remember that 66.80 used to be last support point, which has broken today, and it has opened and gone below that and closed below that today. Tomorrow's confirmation I will definitely like to wait for, and if it closes below that, probably next level which we are looking at is 66.17, which was there in in April 2016, and probably if that breaks, then you will have to change our call for more rupee appreciation from the technical side. However, we have seen a lot of inflows into the market. As you said, there is inflows in the equity. There is also, you could see a lot of masala bonds happening in the market, both on the private as well as private placement or public placement. So all those flows are also coming into the market, and I think people are more or less confident about the RBI's handling of the FCNR scheme, which is going to go out in say next 2 months. So therefore, overall it is quite positive for the rupee right now. Obviously, it is moving along with your dollar index moving down. So we have gained because of that, because of the NFP numbers were also not so good on Friday. So the expectation for a rate hike also has subsided. So all those reasons put together has moved rupee in the direction that it has moved. At this point of time, probably I am a little unsure whether it will go towards 66 or break 66, or will remain around this and then move between say 66.50 to 67. Most possibly, my vote is that it will remain between 66, 67 for the time being. So I am not so sure whether it will break 66 and go down further.
Bhaskar, at what levels are most of the large players put their stop losses, as far as, because I remember at the start of the year we were talking about levels of closer to 70 deposits, the RBI deposit, the outflows, the fear of all of that, but I don't think the rupee has even come close to that levels, and we are just 4 months away from the year end. A lot of people, I'm sure, would be holding their short positions. I'm talking about institutional money. By your own calculation, do you think there would come a time when those stop losses would also trigger? Because everybody has been surprised the amount of flows which have come in, FDI flows into Indian bonds as well as stocks.
I think most of the people who play technically should have put it at around say 66.80. Therefore, I was saying that 66.80 has held on for so long. In fact, even if there was pressure, it was still holding. But today is a day where it has broken. So probably today's move would have triggered some of those kind of stop losses. I don't know actually. I have not direct knowledge of those guys. But still, I feel that is how it would have happened today. So once 66.50 goes, for example, tomorrow, you can look at, as I said, 66.17 and down. But I suspect that too much appreciation from here may not be too good an idea for from export perspective, for our competitiveness perspective. So therefore,
Sure.
I think that it will remain between 66 and 67 for the time being.
Sure, you're right, because beneficiaries, while may rejoice, actually a very strong rupee is not a good thing for the economy, as well as the export end. But apart from that, what is your own sense RBI's intervention or stance would be? Do you think around this level or slightly stronger, they would start interfering or intervening in the market? Because that hasn't happened really a whole lot in the last couple of days at least.
During Dr. Rajan's time, I think we all know that there was more active participation. From today, we have the new RBI governor has taken taken in. So therefore, we don't know what will be his way of functioning in the market. We are still wondering whether he will follow Dr. Rajan's more hands-on approach, or he will follow something different. We are still confused. I haven't seen much intervention in, as you said, in the last couple of days. So we need to wait and watch. Obviously, earlier regime was definitely hands-on, and they used to smoothen the flows into the market. They used to absorb excess flows when it had hit the markets. But I really don't know. I mean, we need to wait and watch the new governor's way of interacting, way of
Sure. All right. Oh yes, Bhaskar, you're right. In a way, the new governor assuming office and the currency market and the money market already giving a salute by ending at such a high level or strong level. With that, we'll end this discussion. Thanks a lot for your time. In fact, it's a wrap on this show. Thanks very much for watching.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.